Welcome to the deep dive. Whether you are a business student staring down a looming exam, a manager trying to understand your department's true budget, or just someone who is intensely curious about how the corporate world operates behind the curtain, you are in the exact right place today. We're going to explore an invisible apparatus that dictates the financial reality of every company on Earth.
Yeah, it's an apparatus most people never even think about until, something goes wrong with their paycheck or their pension,
Sure.
but it is always running in the background.
Right. And our mission for this deep dive is to unpack a foundational document known as Indian Accounting Standard 19, or Ind AS 19. And the specific topic is employee benefits. Now, I know the phrase accounting standard might sound like we are about to just sit here and read a phone book to you.
It does have that reputation.
It really does. But this document is actually the hidden blueprint of every single perk, every salary, and every retirement package a company offers. It is literally the translation of human effort, like your daily grind, into corporate financial reality.
It essentially forces a company to put a highly specific price tag on the human capital it consumes. The entire objective of Ind AS 19 rests on a twofold principle, which really serves as the bedrock for modern financial reporting. First, a company must recognize a liability when an employee provides a service. And second, the company must recognize an expense when it consumes the economic benefit of that service.
Let's ground that in the real world for you listening. We're fundamentally talking about accrual accounting here. If I'm working incredibly hard for a company today, grinding out long hours to earn a performance bonus that won't actually hit my bank account until next year, the company can't just ignore that cost until they actually write the check.
They absolutely cannot. Under the accrual concept, transactions are recognized when they occur, not when the cash changes hands.
So because they are reaping the benefits of my hard work right now today and generating revenue from my labor today, the cost of my labor has to be recognized today.
Exactly. The standard requires an immaculate matching of timelines. For the benefit earned by the company in a particular period, the costs incurred in earning that benefit must be recognized entirely in that same period. The employee provides a service which generates an economic benefit for the employer. The moment that benefit is consumed, the related employee benefit expense hits the books.
It keeps companies honest, really, about what it actually costs to run their business on a day-to-day basis. You can't just hide your labor costs in the future to make today look more profitable. So who are we actually talking about when we say employee? Because looking at the source material, Ind AS 19 goes way beyond just the classic full-time desk-bound corporate worker.
The scope is incredibly broad. When the standard refers to an employee, it naturally includes full-time staff, sure, but it explicitly pulls in part-time employees, permanent employees, casual workers, and temporary workers. And on top of that, it explicitly states that directors and other management personnel fall under this exact same umbrella.
That means the CEO in the corner office and the temporary worker brought in for the holiday rush are governed by the exact same fundamental accounting principles regarding their compensation.
Exactly right.
But the text also points out that the benefits themselves aren't just paid directly to the employee.
Right. If you think about the social function of employment, people work to provide for their families, and AS 19 recognizes this reality. Employee benefits include provisions made not just to the employees themselves, but to their dependents or their beneficiaries. These obligations can be settled by payments made to spouses, to children, or even to third parties like insurance companies.
This actually brings us to one of the most fascinating tensions in the entire source material. The standard doesn't just apply to formal, legally binding written contracts. It captures informal practices. And the text specifically highlights a famous real-world example regarding Google.
Ah, yes, the death benefits policy.
Right. Google has this widely publicized practice where if an employee passes away, they provide the deceased employee's spouse or domestic partner with 50% of their salary for 10 years. That is a massive long-term financial payout. But the crucial accounting detail here is about formal versus informal agreements.
It is. And AS 19 applies to benefits provided under formal plans, obviously, and it applies to benefits required by law, like mandatory state contributions. But it also aggressively targets employee benefits provided by informal practices. If an informal practice creates what the accounting world calls a constructive obligation, the company has to book it as a liability.
Let's dig into that term for a second, because a constructive obligation sounds like a trap for a generous company. If a company doesn't have a binding legal contract to pay a bonus, how does a casual practice suddenly become a hard liability on the balance sheet?
It becomes a hard liability when the entity has no realistic alternative but to pay it. The standard explains that a constructive obligation exists where a change in the entity's informal practices would cause unacceptable damage to its relationship with employees.
Think about the friction that creates between the Human Resources Department and the CFO. HR might want to build a deeply generous corporate culture. They start offering massive informal year-end bonuses, or paying for extravagant wellness retreats, or offering ad hoc severance packages to people who are laid off, and everyone starts to just, well, expect it.
And the moment that expectation becomes entrenched, the accountants have to step in. They have to tell management that because dropping the perk would cause a revolt and essentially damage the relationship with the workforce, the company is trapped by its own precedent. The informal perk is now a mathematically quantifiable binding debt.
It's incredible. The accountants are essentially placing a strict financial value on corporate culture and employee morale. You can't just pretend a massive future payout doesn't exist just because the lawyers haven't drafted a formal contract for it.
You really can't. The numbers have to reflect the reality of the business environment, not just the legal paperwork.
Now, before we wade deeper into this universe, we should quickly clarify to you listening what we are not covering today. The standard explicitly excludes employee stock option plans, or ESOPs. Those are governed by a totally different rule, Ind AS 102, which handles share-based payments. We are also not looking at the reporting by the employee benefit plans themselves, like the financial statements of an independent pension fund. We are strictly looking at the employer side of the equation.
It's a very important boundary. Valuing stock options introduces an entirely different universe of volatility models that would completely derail this discussion.
Definitely. So, dealing strictly with Ind AS 19, how do we organize this massive umbrella of perks, salaries, and pensions? They don't just lump everything into one big employee cost line item.
No, they separate them based on timing, risk, and the fundamental nature of the benefit. The standard establishes four distinct categories: short-term employee benefits, post-employment benefits, other long-term employee benefits, and termination benefits. And each of these requires a completely different accounting treatment.
Let's take them apart. Starting with Category 1, short-term employee benefits. What is the dividing line here?
Time is the dividing line. Short-term benefits are those expected to be settled wholly before 12 months after the end of the annual reporting period in which the employees render the related service.
Meaning the work is done and the employee is fully compensated for that specific work within a year of the financial period closing.
Correct. And this category obviously captures wages and salaries.
Yeah.
But it also includes Social Security contributions, paid annual leave, paid sick leave, profit sharing, and bonuses. Interestingly, it also captures non-monetary benefits for current employees.
Like what?
Medical care, housing, company cars, and free or subsidized goods or services.
So if I work at a retail store and get a 50% employee discount, or if an executive gets a company car, the standard classifies that right alongside their monthly salary as a short-term benefit.
Exactly. It's all part of the short-term compensation package.
But business is unpredictable. What happens if a company fully intends to pay out a profit-sharing bonus within that 12-month window, but a massive cash flow crisis hits and the payment gets delayed to, say, 18 months? Do they have to rip up their financial statements and recategorize the entire liability?
The standard actually builds in a layer of operational grace for that exact scenario. Reclassification of a short-term employee benefit is not required if the entity's expectations regarding the timing of the settlement change temporarily. A temporary delay does not alter the fundamental economic nature of the benefit.
But there is a line they can't cross, right?
Yes. Reclassification is considered if the core characteristics of the benefit change. For instance, if a benefit shifts from being non-accumulating to accumulating, or if it becomes obvious that the delay in settlement is definitely not temporary. At that point, the accounting treatment must shift to reflect the new reality.
That prevents companies from playing games, claiming a massive bonus is a simple short-term benefit when they secretly know they won't pay it out for half a decade.
Precisely. It keeps the balance sheet honest.
Let's look at Category 2, post-employment benefits.
These are payable after the completion of employment, excluding termination benefits or short-term benefits. The source highlights pensions and lump sum payments upon retirement, such as a gratuity, as the primary examples.
These are the massive long-term promises that companies make. We are going to spend a huge portion of this deep dive unpacking exactly how these are calculated because the math is staggering. But let's finish the map first. Category 3, other long-term employee benefits. This sounds like a catch-all bucket for anything that doesn't fit neatly elsewhere.
It serves exactly that function. The standard defines it as all employee benefits other than short-term, post-employment, and termination benefits. The examples provided are long service leave, sabbatical leave, or jubilee benefits.
So if a university promises a professor a fully paid one-year sabbatical after they complete 7 straight years of teaching, that falls here.
Yes.
The university has to accrue that massive cost incrementally over those 7 years. They can't just take a massive hit to their profit and loss statement in year 8.
Because they're consuming the economic benefit of the professor's teaching in years 1 through 7. The liability for that future sabbatical must be built up concurrently with the service being provided.
The matching principle strikes again. Finally, Category 4, termination benefits.
These are benefits provided specifically in exchange for the termination of an employee's employment. However, the standard distinguishes between 2 different catalysts for this termination.
Right. The source outlines that it can happen either because the company makes the decision to terminate an employee before their normal retirement date, or because the employee makes the decision to accept an offer of benefits in exchange for leaving.
In practical terms, the first scenario covers retrenchment compensation, or involuntary layoffs. The second scenario covers things like a voluntary retirement scheme, or VRS, where a company puts a financial package on the table and the employee voluntarily opts to take it. Both trigger the accounting rules for termination benefits.
All right, that is the broad architecture. Short-term, post-employment, other long-term, and termination. I want to pivot now and wade into the deepest, most complex waters of this standard.
The post-employment plans.
Exactly. When a company promises to take care of its workforce after they retire, how do they actually structure and account for that? Because the financial risk involved in funding someone's life for 20 years after they stop working is astronomical.
It is the single largest area of risk in employee compensation. Ind AS 19 divides post-employment benefit plans into 2 vastly different categories: defined contribution plans and defined benefit plans. The distinction between the 2 dictates who carries the financial risk of the future.
Let's break down defined contribution plans first.
In a defined contribution plan, the employer agrees to pay a fixed contribution into a separate entity, a fund. The defining characteristic is right in the name. The contribution is what is defined.
So the company signs an agreement saying, we will put 5,000 rupees a month into this retirement fund for you.
Yes, and here is the critical limitation of the employer's liability. The employer has absolutely no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets to pay all employee benefits.
Listeners, really think about the implications of that. If the fund takes that 5,000 rupees a month, invests it heavily in the stock market, and the market absolutely collapses right before the employee retires, the employee's retirement account is decimated. But what happens to the employer?
The employer faces no financial consequence. They made their defined contribution every month as promised. Their obligation is entirely fulfilled. Under defined contribution plan, the investment risk, the risk that assets will underperform, and the actuarial risk, the risk that the employee lives longer than expected, fall entirely upon the employee.
The source gives the example of the Provident Fund contribution by an employer to the employee's Provident Fund organization under the Government of India. The employer pays their required percentage into the state apparatus, and their hands are washed of the future risk. Now contrast that with the second category, defined benefit plans.
The standard actually uses a negative definition here. A defined benefit plan is simply a post-employment benefit plan that is other than a defined contribution plan.
But the economic reality of that negative definition is a complete reversal of the risk profile. If the contribution isn't what is defined, then the benefit is what is defined.
Exactly. The employer is promising a specific payout at the end of the employee's career. Take a gratuity, for example. The employer promises that upon retirement, based on a formula involving years of service and final salary, the employee will receive a precise lump sum.
I'd argue that this is a terrifying proposition for a modern CFO. If the company sets money aside in a trust to eventually pay that gratuity, and the investments in that trust perform terribly, the promised benefit doesn't change. The formula still demands the same final payout.
And that is the crux of the defined benefit plan. The employer bears the investment risk and the actuarial risk. If the trust fund is short, the employer must dig into its own current operating cash to make up the shortfall. The liability is theoretically open-ended.
Which is why we've seen a massive global shift away from defined benefit plans over the last few decades. Companies realized they were essentially acting as massive, unregulated insurance companies, carrying decades of market risk on their balance sheets just to provide pensions.
Yes, it became unsustainable for many businesses.
Before we look at how that massive liability is calculated, the text mentions a hybrid arrangement. Multi-employer plans. How do these fit in?
Multi-employer plans pool the assets contributed by various entities that are not under common control. They use those pooled assets to provide benefits to employees of more than one entity. The defining feature is that the contribution and benefit levels are determined without regard to the identity of the specific entity that employs the individual.
So several unrelated companies throw their contributions into a giant shared pot, and the benefits are paid out of that collective pool. The standard notes these can be structured as either defined contribution or defined benefit plans.
Right.
But let's focus on the beast. Measuring a single employer defined benefit plan. Because a company is on the hook for a specific future payout, the accounting required to measure this obligation is intensely complex. The source provides a vocabulary list of technical terms that we need to translate. Let's start with the bottom line, the net defined benefit liability or asset.
This is the final number that actually appears on the balance sheet. The standard defines it as the deficit or surplus, adjusted for any effect of limiting a net defined benefit asset to the asset ceiling.
Okay, we need to peel that onion. It introduces two more concepts, the deficit or surplus and the asset ceiling. How do you calculate a deficit or surplus in a pension plan?
It is the difference between two massive moving targets. You take the present value of the defined benefit obligation and you subtract the fair value of the plan assets.
The present value of the obligation is the estimated total pile of money you owe your employees in the future for the work they have already done, discounted back to today's value. The fair value of plan assets is the actual pile of money you have locked away in a trust fund today to pay for it.
That's a great summary.
So if your obligation is larger than your assets, you have a deficit, a liability. But what if the stock market goes on an unprecedented bull run, your trust fund explodes in value, and suddenly you have way more assets than obligations? You have a surplus. Can a company just slap that massive surplus on their balance sheet and tell investors they are suddenly worth millions more?
They cannot. And this is where the asset ceiling acts as a strict regulatory brake. The asset ceiling is defined as the present value of any economic benefits available in the form of refunds from the plan or reductions in future contributions to the plan.
This is a vital concept for you listening as an investor to understand. If a company overfunds its pension plan, the standard demands prudence. It says you can only claim that surplus as an asset on your books to the extent that you can actually extract economic value from it. If the rules of the trust fund explicitly state that the employer can never, ever take cash back out of the fund, then a massive surplus is essentially trapped.
And if it is trapped, it provides no economic benefit to the reporting entity. Therefore, the asset ceiling limits the recognized asset to zero or to whatever minor amount they might save on future contributions. It prevents companies from artificially inflating their corporate net worth with untouchable pension wealth.
It stops accounting fiction. Now let's talk about the assets themselves. When a company calculates that surplus or deficit, they subtract the fair value of plan assets, what legally qualifies as a plan asset. A company can't just point to their corporate headquarters or the intellectual property of their software and say, if push comes to shove, we'll sell our patents to pay the pension, so count that as a plan asset.
The standard builds a massive wall around what qualifies. Plan assets generally comprise two things: assets held by a long-term employee benefit fund and qualifying insurance policies.
Let's look at the fund first. How high is that wall?
It is legally impenetrable. To qualify, the assets must be held by an entity, like a trust or a fund, that is legally separate from the reporting entity. Furthermore, it must exist solely to pay or fund employee benefits. Most importantly, these assets must be completely shielded. They are available to be used only to pay or fund employee benefits, and they are not available to the reporting entity's own creditors, even in the event of bankruptcy.
Think about the immense protection that provides to the worker. If a massive corporation collapses under a mountain of debt and files for bankruptcy, the creditors will liquidate the factories, the patents, the office furniture, but they cannot touch the pension fund. The accounting standard demands that true plan assets are entirely legally segregated from corporate risk.
Yes, the workers' futures are secured.
And the company can't just quietly raid the fund if they hit a rough quarter, right?
The assets cannot be returned to the reporting entity unless two very specific conditions are met. Either the remaining assets of the fund are sufficient to meet all related employee benefit obligations, meaning it is a true, undeniable surplus, or the assets are returned strictly to reimburse the company for employee benefits it has already paid out of its own pocket.
That covers the trust funds. What about the second type of plan asset mentioned in the source? Qualifying insurance policies.
A qualifying insurance policy is issued by an insurer that is strictly not a related party of the reporting entity, and the proceeds of this policy must be subject to the exact same stringent protections as a trust fund. The proceeds can only be used to pay employee benefits. They are shielded from the employer's creditors in bankruptcy, and they cannot be paid back to the employer except as a surplus or a reimbursement.
I notice a fascinating regulatory quirk in the notes regarding these policies. The standard explicitly states that a qualifying insurance policy under Ind AS 19 is not necessarily an insurance contract under Ind AS 117.
It highlights how pragmatic Ind AS 19 is. Ind AS 117 governs the incredibly complex accounting for insurance contracts broadly. But Ind AS 19 is looking purely at the function of this specific policy. It doesn't care if the policy meets the labyrinthine technical definition of an insurance contract under the other standard. If it functions as a shielded, legally separate vehicle to fund employee benefits, it qualifies as a plan asset here.
And when accountants actually calculate the value of these trust funds or policies to find the deficit or surplus, the standard demands they use fair value. I'll provide the definition borrowed from Ind AS 113. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date.
It is truthless realism.
It really is. You do not value the pension fund's stock portfolio based on what you bought it for a decade ago. You value it based on what a willing buyer would pay a willing seller in the open market today. If the market crashed yesterday, your fair value crashed yesterday and your deficit just exploded.
Which perfectly transitions us to how this massive, volatile obligation actually translates into a cost on the company's profit and loss statement each year.
Right. When a company tells its investors, our defined benefit pension plan cost us 50 million rupees this year, how is that number actually built? Because it's not just the cash they contributed.
The defined benefit cost, recognized in the financial statements, is essentially a composite of three highly distinct elements: service cost, net interest, and remeasurements.
Let's unpack the first element, service cost. What goes into this bucket?
Service cost itself has three subcomponents. The most straightforward is the current service cost. This is the increase in the present value of the defined benefit obligation resulting directly from employee service in the current period.
It's the cost of the pension promise you made in exchange for the sweat equity the employee gave you this exact year.
Exactly. But the second subcomponent is where corporate decisions create massive accounting ripples: past service cost.
I'd argue that sounds like a paradox. How can the cost of work an employee performed 5 years ago suddenly change today?
It changes when management alters the fundamental rules of the game. Past service cost is the change of the present value of the obligation for employee service in prior periods, resulting from a plan amendment or a curtailment.
Give me an example of a plan amendment.
Suppose a company has a highly profitable year, and the CEO decides to make the retirement formula more generous. Crucially, they apply that new generosity retroactively to all the years the employees have already worked.
So an employee who has been there 20 years suddenly has their 20 years of past service revalued at a much higher rate.
Yes. That creates a massive, immediate new liability for past service, which must be recognized today as a past service cost. The standard defines a plan amendment as the introduction, withdrawal, or change to a defined benefit plan.
But past service cost isn't always caused by generosity. You mentioned curtailments.
A curtailment is a significant reduction by the entity in the number of employees covered by a plan. If a manufacturing company permanently shuts down a massive factory and lays off thousands of workers who are vested in the pension plan, the entire actuarial structure of their obligation changes instantly. That structural shift hits the service cost.
Makes sense. And the third part of service cost?
It's any gain or loss on a settlement. If a company decides to completely settle a portion of its obligation by offering employees a lump sum cash buyout to exit the pension plan entirely, the amount they actually pay out might differ from the liability they had accrued. That difference is a gain or loss on settlement.
So service cost captures the current labor, retroactive plan tweaks, mass layoffs, and cash buyouts. What is the second major element of defined benefit cost?
The second element is purely driven by the mathematics of time. Net interest on the net defined benefit liability or asset.
I want to focus on this because it exposes a concept that trips up a lot of people: discounting. If a company owes 1 million rupees to a retiring employee 20 years from now, they don't put 1 million rupee liability on their balance sheet today.
They cannot, because 1 million rupees today is not worth the same as 1 million rupees in 20 years. The standard requires that long-term obligations be discounted to their present value.
So, using a discount rate, that million rupee future obligation might only be recorded as a 400,000 rupee liability today. But here is the catch. As each year passes, and you get 1 year closer to the actual payout date, that discount has to unwind. The liability has to grow from 400,000 back up to the full million.
And that annual growth, caused by nothing more than the relentless passage of time, is recognized as an interest cost. It is the change during the period in the net defined benefit liability or asset that arises from the passage of time.
It's incredible. The company didn't borrow any new money from a bank, they didn't change the pension formula, but they still have to book a massive interest expense simply because the calendar year changed.
Time is money, literally, on the balance sheet.
Now, the third element of defined benefit cost is where the tension really peaks. We've talked about service and interest, but predicting a pension requires predicting the future. That brings us to remeasurements of the net defined benefit liability or asset.
This is where the actuaries earn their fees. Remeasurements consist of three distinct adjustments. The most significant are actuarial gains and losses.
What forces an actuary to recalculate a massive liability and declare a gain or a loss?
Actuarial gains and losses result from two factors. The first is experience adjustments. This is the accounting mechanism for acknowledging that the real world deviated from the actuary's mathematical model.
Give me a real-world scenario of an experience adjustment.
An actuary builds a model, assuming that 5% of the workforce will resign before their pension vests, meaning the company won't have to pay them. But an aggressive competitor enters the market and starts poaching staff. Suddenly, 12% of the workforce resigns. The company's actual experience deviated wildly from the assumption, significantly lowering their ultimate pension liability. That creates an experience adjustment.
But the second factor, causing actuarial gains or losses, doesn't rely on what actually happened. It relies on changes to the assumptions themselves.
Yes, changes in actuarial assumptions. Actuaries must constantly project future variables. Mortality rates, employee turnover, early retirement behaviors, and future salary increases. Consider mortality tables. If national demographic data is updated to show that advancements in healthcare are causing the average citizen to live 3 years longer, the actuary must immediately update their assumption.
And if the workforce lives 3 years longer, the company has to pay 3 more years of pensions to everyone. The present value of the entire defined benefit obligation instantly balloons. A demographic shift in the health of the general population immediately hits a corporate balance sheet as a devastating financial loss.
It perfectly illustrates how macroeconomic and societal shifts are internalized by corporate accounting through Ind AS 19.
The second part of remeasurements looks at the other side of the ledger, the return on plan assets.
This is how the trust fund actually performed in the market. It includes the interest, dividends, and other income derived from the plan assets, along with realized and unrealized gains or losses on those investments. However, you must meticulously exclude any amounts already included in the net interest calculation we discussed a moment ago to avoid double counting.
Right.
Crucially, from this gross return, the standard requires you to deduct the costs of managing the plan assets, the fees paid to the fund managers, and any taxes payable by the plan itself.
And the final piece of the remeasurement puzzle brings us back to that regulatory break we discussed earlier.
Yes, the third component is any change in the effect of the asset ceiling, again excluding amounts included in net interest. If the regulatory or economic environment changes, altering the amount of surplus the company can actually extract as a refund or contribution reduction, that change is immediately booked as a remeasurement.
So when a listener sees a single line item on an income statement labeled defined benefit pension cost, they need to realize it is a chaotic amalgamation. It is basically a messy soup of current daily labor, retroactive CEO generosity, the unwinding of complex discount rates, the harsh reality of stock market volatility, and an actuary's best guess about human mortality. It is a stunning piece of financial architecture.
It really is.
Which is why I want to pivot entirely. Let's step out of the decades-long projections and look at the immediate present, the mechanics of short-term benefits. When we talk about standard monthly payroll, the standard takes a completely different philosophical approach.
It is significantly more straightforward, providing a necessary relief from the complexities of defined benefit plans. Accounting for short-term benefits is defined by two key exemptions. First, short-term benefits are measured on an undiscounted basis. Second, they do not involve any actuarial valuation whatsoever.
Because the time horizon is less than 12 months, the standard essentially says that the time value of money over such a short period is immaterial. We don't need to discount a payroll check that will be cashed in 3 weeks. We don't need an actuary to predict if an employee will survive the month.
Exactly.
So, what are the actual recognition rules? How does the accountant record the basic cost of doing business?
The primary rule is grounded in simple accrual logic. The undiscounted amount of short-term employee benefits expected to be paid in exchange for service shall be recognized as a liability and accrued expense after deducting any amount already paid.
If my workforce earns 1,000,000 rupees this week and the pay cycle hasn't hit yet, I simply recognize an accrued liability of 1,000,000 rupees. But what if the opposite happens? What if a company prepays an employee?
That triggers the asset exception. If the amount already paid exceeds the undiscounted amount of the benefits earned, the entity shall recognize that excess as an asset specifically, a prepaid expense. However, the standard again enforces prudence. This asset can only be recognized to the extent that the prepayment will lead to a tangible economic benefit, such as a reduction in future payments or a direct cash refund.
If I accidentally pay an employee double this month, I can book a prepaid asset because I simply won't have to pay them next month. The economic benefit is the cash I save in the future. Now, normally when a company recognizes that payroll liability, the corresponding entry hits the profit and loss statement as an immediate expense. But the source outlines a fascinating scenario called the capitalization exception.
Yes, the short-term benefit is recognized as an immediate expense unless another accounting standard explicitly requires or permits it to be built into the cost of an asset.
Let's expand on this because it challenges the idea that a salary is always just an expense. The source references Ind AS 2, which governs inventories, and Ind AS 16, which governs property, plant, and equipment.
Consider an employee working on an assembly line manufacturing heavy machinery. The wages paid to that employer is not merely an administrative cost of keeping the lights on. Their labor is fundamentally transforming raw steel into a highly valuable piece of inventory.
Therefore, under Ind AS 2, the company doesn't just expense those wages to the income statement, they capitalize the wages. The cost of the employee's labor literally becomes part of the financial value of the tractor sitting on the balance sheet. The expense isn't truly recognized until the company finally sells the tractor.
Or take Ind AS 16. If a team of internal corporate engineers and construction workers spends 2 years building a new, state-of-the-art manufacturing facility for their own company, their salaries are not expensed immediately. Their labor is physically manifesting as a long-term asset. Their salaries are capitalized into the value of the building on the balance sheet.
It's a profound shift in perspective. Labor isn't always just money out the door. Sometimes labor is money converted into physical corporate infrastructure. Let's move to a topic that almost every listener has dealt with personally, and yet it creates massive headaches for corporate controllers. Paid absences, commonly known as leave encashment.
Employers compensate employees for absence for a variety of reasons: holidays, sickness, short-term disability, maternity, or jury service. But from an accounting perspective, under Ind AS 19, the entitlement to these paid absences falls into two strict binary categories: accumulating and non-accumulating.
Let's define the boundary between the two. Accumulating paid absences are exactly what they sound like. You earn them progressively over time, and if you don't use them in the current period, they roll over to the next period.
And because they are earned incrementally, the standard mandates that they are recognized when the employee renders the service that increases their future entitlement. Every single day an employee works, they might earn a fraction of an annual leave day. The company must recognize the liability for that fraction of a day immediately as the service is rendered.
Conversely, non-accumulating paid absences do not carry forward. They lapse if the current period's entitlement is not used in full.
Things like maternity leave, paternity leave, or jury duty are classic examples of non-accumulating absences. You do not earn maternity leave days by working for 5 years and saving them up. Because there is no future entitlement being built up over time, the company does not accrue a liability in advance. These are recognized as an expense only when the absence actually occurs.
Now, within the realm of accumulating absences, the vacation days or sick days that you can bank and roll over in AS 19 introduces another crucial divide that completely alters the financial calculus. Vesting versus non-vesting. What does it mean for a leave entitlement to vest?
If accumulating leaves are vesting, it means the employees are legally entitled to a cash payment for their unutilized entitlement if they leave the entity. If an employee resigns with 15 days of accrued vacation, the company must write them a check for the value of those 15 days.
Right.
If the leaves are non-vesting, employees are not entitled to a cash payment for unused entitlement upon leaving. It is a strict use-it-or-lose-it scenario. If they resign with 15 days saved up, those days simply evaporate.
This brings us to what I consider the most counterintuitive mandate in this entire standard. If a company offers non-vesting leaves, meaning if the employee quits tomorrow, the company legally owes them exactly zero cash for their saved-up days. Does the company still have to record a liability for those days on their balance sheet while the employee is actively working?
They absolutely do. This is a critical insight into the prudence of Ind AS 19. The obligation exists and must be recognized even if the paid compensated absences are non-vesting.
Let me stop you there, because a CFO might scream, "Why am I booking a liability for a cash payout I might never have to make? It feels like a ghost liability."
The standard doesn't view it as a ghost liability because it assumes the ongoing nature of employment. The entity must measure the expected cost of accumulating paid absences as the additional amount it expects to pay as a result of the unused entitlement that is accumulated.
Okay, explain that expectation part.
If an employee has saved up 20 days of leave, the company has an obligation to pay that employee their full salary for 20 days in the future, during which the employee will provide absolutely zero productive service in return. That is a future economic burden. It is a liability.
But the standard does acknowledge the reality of the use it or lose it policy, right? They don't have to assume a 100% payout.
Correct. Because it is non-vesting, the measurement of this obligation will be heavily affected by probability. The actuaries and accountants must estimate the probability that employees will actually utilize the accumulated leave before they resign or are terminated. The liability is discounted by the probability of forfeiture.
It's an incredibly delicate balancing act between predicting human fatigue, like when will they take a vacation, and predicting corporate turnover. To really solidify this, we need to abandon the theory and look at the actual business impact. The source material provides some excellent concrete illustrations that show exactly how dangerous lazy accounting can be when dealing with leave encashment.
They do. They break it down mathematically.
Let's step into the shoes of the financial controller for a hypothetical company called Infotech Ltd. and see how accrual accounting works in practice over a 2-year period. We will look at 2 employees. Illustration 1 deals with vested accumulating benefits. Meet Mr. Rajan.
Here is the baseline setup for Mr. Rajan. His annual salary is exactly 30 lakhs, or 3 million rupees. The total number of working days in the financial year, let's call it year 1, is 300 days.
A quick calculation tells us the daily value of his labor. 30 lakhs divided by 300 working days means Mr. Rajan earns exactly 10,000 rupees per day.
Infotech Ltd. has a policy allowing for 10 days of paid leave during the year. In year 1, Mr. Rajan utilizes 8 of those days,
leaving him with 2 unutilized leave days.
And here's the defining characteristic of his contract. The unutilized leaves are settled by way of immediate cash payment at the end of the year. Carry forward is strictly not allowed. These are fully vested benefits. The fundamental accounting question is, what is the total employee benefit expense that Infotech must recognize for Mr. Rajan in year 1?
The math here is clean and immediate. Infotech consumed 292 days of his labor. That's 300 days minus the 8 he took off. They owe him his base salary of 30 lakhs. Plus, because the policy mandates a cash payout for the unused days, they owe him for those 2 extra days. At 10,000 rupees a day, that is an additional 20,000 rupees.
Right.
So Infotech's total expense is the 30 lakh base salary plus the 20,000 leave encashment. The total employee benefit expense recognized hitting the profit and loss statement is 30 lakhs, 20,000 rupees. It is a simple transaction. The cash leaves the bank and the expense is booked. But illustration 2 fundamentally alters the scenario. This focuses on non-vested accumulating benefits. Meet Mr. Naranjan.
Mr. Naranjan operates under the exact same compensation structure, an annual salary of 30 lakhs, 300 working days in the year, resulting in a daily rate of 10,000 rupees. He is also allowed 10 days of leave per year.
Okay, same baseline.
However, we are going to analyze his behavior over a 2-year span. In year 1, Mr. Naranjan takes 7 days of leave. Crucially, his contract allows him to carry forward his 3 unutilized days to the next year. In year 2, Mr. Naranjan decides to take a long vacation. He utilizes 13 days of leave. That consumes his regular 10 days for year 2, plus the 3 days he carried forward from year 1. He carries 0 days forward into year 3. Now, here is where corporate accountants often try to take a dangerous shortcut. Infotech Ltd. looks at this timeline and proposes a simplified approach. They argue, look, we know Niranjan carried over 3 days, but we also know he's going to use them next year. Over the 2-year period, it all washes out. We pay him 30 lakhs in cash in year 1 and 30 lakhs in cash in year 2. Let's just book a flat 30 lakh expense each year and avoid the complex accrual math. And this is precisely where an auditor armed with Ind AS 19 will fail their financial statements. The proposal violates the most sacred rule of accrual accounting, the matching principle.
I'd argue it completely misrepresents the company's actual productivity. Why is Infotech entirely wrong to just book a flat 30 lakhs each year?
Because you must look at the actual volume of service provided by Mr. Niranjan in each discrete financial period. You must match the expense to the service actually received, not the cash paid. Let's break down the physical labor. In year 1, out of 300 working days, Mr. Niranjan took 7 days of leave. Therefore, he was physically present and provided productive service for 293 days.
And in year 2?
In year 2, out of 300 working days, he took 13 days of leave. He was only present and providing productive service for 287 days.
The disparity is massive when you look at it that way. He worked 6 more days in year 1 than he did in year 2. He provided significantly more economic benefit to Infotech in year 1.
Precisely. And the accrual concept demands that if you receive more economic benefit from an employee in a given period, you must recognize a proportionally higher expense in that exact same period to match it. If Infotech just recognizes a flat 30 lakhs each year, they are artificially underreporting their true labor costs in year 1 and artificially overreporting their costs in year 2.
Which misleads investors about how efficiently the company operated in each specific year. So how do we properly apply Ind AS 19 to fix this? Let's do the proper math to match the expense to the service.
In year 1, Infotech must recognize the base salary plus the expected cost of the 3 unutilized days that they expect him to consume in the future. The calculation for year 1 is his 30 lakh base salary plus the cost of the 3 unutilized days valued at 10,000 rupees a day, which is 30,000. Therefore, the true matched expense recognized in year 1 is 30 lakhs, 30,000 rupees.
So instead of just showing the cash leaving the bank, the company has to actually create a bucket on their balance sheet called a provision for leave encashment for that extra 30,000. It is a flashing warning sign to investors that says, we received the benefit of his labor today, but we owe this guy paid time off in the future. And what happens to that provision in year 2?
In year 2, Mr. Niranjan takes those extra 3 days off. He's working less, providing less economic benefit, but still receiving his full base salary in cash. To accurately reflect this reduced service, the expense must be lower. The calculation for year 2 is his 30 lakh base salary minus the value of the 3 excess days utilized from the previous year. That is 30 lakhs minus 30,000. The true expense recognized in year 2 is only 29 lakhs, 70,000 rupees.
The symmetry is beautiful. 30 lakhs, 30,000 in year 1. 29 lakhs, 70,000 in year 2. The total cash paid out over 2 years is 60 lakhs. The total expense booked over 2 years is 60 lakhs. But the timing of the expense perfectly reflects when the actual physical work was performed on the factory floor. That is accrual accounting, stripping away the illusion of cash flow to reveal the true operational reality.
It's elegant when it works perfectly.
But there's a final wrinkle here. This perfect symmetry relies entirely on Infotech perfectly predicting Mr. Niranjan's behavior. Illustration 3 tackles the reality of human unpredictability when estimates change.
Accounting is not static. It is highly dependent on realistic, data-driven estimates that must be constantly revised. Let's alter the assumptions of the previous scenario. In year 1, Mr. Niranjan still carries forward 3 days of leave. But this time, Infotech Ltd. analyzes their historical HR data and realizes that employees rarely take all their carried forward leave before it expires. Based on this data, Infotech only expects Mr. Niranjan to actually utilize 2 of those 3 carried forward days next year. They assume the 3rd day will lapse.
How does that shift the mathematical burden in year 1?
AS 19 dictates that you measure the expected cost of accumulated absences based strictly on the additional amount the entity actually expects to pay. If their data-driven assumption is that he will only use 2 days, they can only accrue an expense and a liability for 2 days. So in year 1, the expense is booked based on that expectation. The 30 lakh base salary plus 2 expected days at 10,000 rupees. The total recognized expense is 30 lakhs, 20,000.
But humans routinely defy corporate expectations. What happens in year 2 if Mr. Niranjan suffers burnout? and decides he needs every single hour of rest he is entitled to. He actually takes all 3 days of his carried forward leave, defying the assumption.
This creates an experience adjustment, a concept we discussed regarding pension plans, applied here to short-term leave. The reality deviated from the estimate. In year one, Infotech booked the expense based on their best legally defensible estimate at the time. They do not go back and restate year one. Instead, when the reality changes in year two, when he takes the third day, the accounting for year two must absorb that unexpected difference to ensure the total payout balances correctly.
It proves that a corporate balance sheet isn't just a historical record of what happened. It is a living, breathing document, constantly attempting to predict human behavior and constantly correcting itself when those predictions fall short. We have traversed an incredible amount of terrain today, diving deep into the plumbing of corporate finance. Let's pull back and summarize the massive scope of what Ind AS 19 actually achieves.
It's a lot to take in.
We started by recognizing that an accounting standard is essentially the financial translation of human effort. We explored how a well-intentioned company culture, whether it's Google's death benefit or an HR department's informal habit of providing generous severance, can quietly morph from a friendly gesture into a binding, constructive obligation. We highlighted the tension this creates between HR and accounting, where informal generosity creates massive legal liabilities.
We broke down the four categories of benefits: short-term, post-employment, long-term, and termination, revealing why the timeline of a promise dictates its financial weight.
Exactly.
We spent significant time unpacking the colossal risks embedded in post-employment benefits. We explore the stark contrast between defined contribution plans, where the employee bears the market risk, and defined benefit plans, where the employer carries the massive, open-ended burden of funding retirements. We saw how that burden is measured using complex concepts like present value discounting, the strict ring fencing of plan assets from bankruptcy creditors, and the ruthless reality of fair market valuation.
We also demystified the chaotic soup of defined benefit cost, showing how current labor, retroactive plan amendments, the unwinding of interest, and the constant stressful experience adjustments made by actuaries all converge into a single line item on an income statement. And finally, we brought it back to the daily grind, examining the mechanics of short-term benefits and leave encashment. We saw how the simple act of Mr. Naranjan carrying a sick day across a financial year forces a company to meticulously match their expenses to the actual days he provided service, rather than taking the lazy shortcut of just tracking cash.
The overarching takeaway from Ind AS 19 is one of immense, unseen scale and complexity. The next time you glance at your monthly payslip, or casually request a paid holiday, or check the balance of your retirement fund, recognize the massive apparatus operating behind the scenes. There's an army of actuaries, corporate controllers, and stringent international frameworks spinning constantly in the background. They are meticulously tracking demographic shifts, market volatility, and your individual daily labor, translating all of it into the global financial reality of corporate enterprise. Your work is being counted, weighed, discounted, and projected decades into the future.
It certainly changes how you view your relationship with your employer, which leads me to a final thought I want to leave you with. Something to consider as you navigate your own career. We spent time dissecting the concept of constructive obligations, the reality that informal practices, if expected by the workforce, become actual hard financial liabilities on a company's balance sheet.
Right, the informal turning into the formal.
If a company prides itself on a culture of casual, unwritten generosity, providing free daily lunches, extravagant wellness stipends, or ad hoc bonuses, the accountants eventually have to value that expectation and book it as a corporate debt. So does that mean a deeply generous, spontaneous company culture is, strictly in accounting terms, a massive financial vulnerability? If simply being nice creates a legally binding expectation that actively drags down a company's net worth, is modern accounting fundamentally at odds with casual corporate generosity? Does a spreadsheet inherently punish the benevolent employer? Think about that the next time you grab a free coffee in the break room. Thanks for joining us on this deep dive.